Good morning, grade 11 senior high school students of Cauayan City National High School. For today's video lesson, we will talk about basic concepts of stocks and bonds. There are two ways to make money in our modern world. The first way is to earn money from income by working by yourself. The other way to grow your fortune is to invest your assets so that it will increase its value over time. In this video lesson, you may learn the different markets of stocks and bonds to help you earn money by saving money for your future use. For example, of which is investing in a certain corporation, organization, or company with higher possibility to gain profit. For the objective of this video lesson, we will illustrate stocks and bonds, distinguishes between stocks and bonds, describe the different markets for stocks and bonds, analyze the different market indices for stocks and bonds. Let us start by the definition of stock market. It is a place where investors go to trade equity, securities, example shares, issued by corporations. Stock market are shares in the ownership of the company. There are two types of stocks, common stock and preferred stock. Both receives dividends or share earnings of the company. Dividends are paid first to preferred shareholders. Stocks can be bought or sold at its current price called the market value. Bond market. It is where investors go to buy and sell debt securities issued by corporations or governments. Bond are interest-bearing securities which promises to pay amount of money on a certain maturity date as stated in the bond certificate. Bond holders are lenders to the institution which may be a government or private company. Take note, bondholders do not vote in the institution's annual meeting but the first to claim in the institution's earning. Let's have the comparison between stocks and bonds. Stocks, a form of equity financing or raising money by allowing investors to be part owners of the company, while bonds, it is a form of debt financing or raising money by borrowing from investors. Stocks prices vary every day. These prices are reported in various media such as newspaper, TV, internet, and etc. Investors are guaranteed interest payments and a return of their money at the maturity date for bonds. For stocks, investors can earn if the stock prices increases, but they can lose money if the stock prices decreases or worse, if the company goes bankrupt. While bonds, investors still needs to consider the borrower's credit rating. Bonds issued by the government pose less risk than those by companies because the government has guaranteed funding or the taxes from which it can pay its loan. For stocks, higher risk but with possibility of higher return. For bonds, lower risk but lower yield. For stocks, can be appropriate if the investment is for the long term, 10 years or more. This can allow investors to wait for stock prices to increase if they go low. For bonds, can be appropriate for retirees because of the guaranteed fixed income, or for those who need the money soon because they cannot afford to take a chance at the stock market. Stocks. It is a share in the ownership of the company. Dividend. Share in the company's profit. Dividend per share. It is a ratio of dividends to the number of shares. Market value. The current price of stock at which it can be sold. Stock yield ratio. A ratio of the annual dividend per share and the market value per share, also called the current stock yield. Par value. It is the per share amount as stated on the company certificate. Unlike market value, it is determined by the company and remains stable over time. For example, a certain financial institution declared a 30 million pesos dividend for the common stock. If there are a total of 700,000 shares of common stock, how much is the dividend per share? We will have a given that is a total dividend that is 30 million pesos and the total share that is 700,000 pesos. We have a solution that is, for the formula, dividend per share is equal to total dividend divided by total shares. Then we have 300 30 million pesos divided by 700,000 pesos is equal to 42.86. Therefore, the dividend per share is 42.86 pesos. Let's have another example. A certain corporation declared a 3% dividend on stock with a par value of 500 pesos. Ms. Ruth owns 200 shares of the stock with a par value of 500 pesos. How much is the dividend she received? We have a given that is dividend percentage that is equal to 3% and a par value of 500 pesos. For our solution, the dividend per share is computed as 500 pesos multiplied to 0.03, that is equal to 15 pesos. Since there are 200 shares, the total dividend is 15 pesos per share multiplied to 200 shares is equal to 3,000 pesos. Therefore, our formula that we will be used is dividend is equal to dividend percentage multiplied to par value multiplied to number of shares is equal to 0.03 multiplied to 500 multiplied to 200, that is equal to 3,000 pesos. Therefore, the dividend of Ms. Ruth is 3,000 pesos. Another example. A corporation A with a current market value of 52 pesos gave a dividend of 8 pesos per share for its common stock. Corporation B with a market value of 95 pesos gave a dividend of 12 pesos per share. Use the stock-yield ratio to measure how much dividends shareholders are getting in relation to the amount invested. For Corporation A, our given will be dividend per share is 8 pesos, our market value is 52 pesos. For our solution, we will make use of the formula stock-yield ratio is equal to dividend per share divided by market value. Our stock-yield ratio will become 8 all over 52, that is 0.1538. Then our stock-yield ratio will be 15.38%. For Corporation B, our given will be dividend per share is equal to 12 pesos and our market value is 95 pesos. For our solution, we will make use again the formula of stock-yield ratio, that is dividend per share all over market value, that is equal to 12 all over 95. And 12 all over 95 is equal to 0.1263. And our stock-yield ratio will become 12.63%. Coupon. It is a periodic interest payment that the bondholder receives during the time between purchase date and maturity date, usually received called coupons. Coupon rate. It is the rate per coupon payment period, denoted by R. Price of a bond. It is the price of the bond at purchase time, denoted by P. Par value or face value, the amount payable of the maturity date, denoted by F. There are conditions of par value or face value. First, if P is equal to F, the bond is purchased at par. Second, if P is less than F, the bond is purchased at a discount. Third, if P is greater than F, the bond is purchased at premium. Term of a bond. It is a fixed period of time, take note it is in years, at which the bond is redeemable as stated at the bond certificate. Number of years from the time of purchase to maturity date. Fair price of a bond. Present value of all cash inflows to the bond holders. For example, determine the amount of semi-annual coupon for a bond with a face value of 300,000 pesos that pays 10% payable semi-annually for its coupons. For our given, we have face value F is equal to 300,000 pesos and our coupon rate, that is R, is equal to 10%. For our solution, annual coupon amount is computed as 300,000 pesos multiplied to 0.10, that is equal to 30,000 pesos. For our semi-annual coupon, that is 30,000 pesos divided by 2 because it is semi-annual, that is equal to 15,000 pesos. Thus, the amount of semi-annual coupon is 15,000 pesos. Take note, that the coupon rate is used only for computing the coupon amount, usually paid semi-annually. It is not the rate at which money grows. Instead, current market conditions are reflected by the market rate and it is used to compute the present value of future payments. Stock Market Index. It is a measure for a portion of stock market. One example is the PSE Composite Index or the PSEI. It is composed of 30 companies carefully selected to represent the general movement of market prices. The up and down movement in percent change over time can indicate how the index is performing. Sector indices. Each representing a particular sector. For example, financial institution, industrial corporations, holding firms, sector corporations, mining oil, and property. The stock index can be standard by which investors can compare the performance of their stocks. A financial institution may want to compare a performance with those of others. This can be done by comparing with the financial index. Stock index table. Stock indices are reported in the business section of magazines or newspapers as well as online at www.pse.com.ph/stockmarket/home.html. The following table shows how a list of indices values is typically represented. The values are hypothetical. Let's have the definition that is being used in the stock index table. First, that is VAL. It is the value of the index. Second, CHG, change of the index value from the previous trading day. Example, value today minus value yesterday. Third, and CHG, it is a ratio of CHG to VAL. Example, CHG divided by VAL. Or the change divided by value. Stock table, a table that shows a report of various information about the stock market. An example is shown in the table. Let's have the definition that is being used on our stock tables. 52-week high/low. Highest or lowest selling price of the stock in the past 52 weeks, high or low. Highest or lowest selling price of the stock in the last trading day. Stock, three-letter symbol that the company is using for trading. DIV or the dividend per share last year. Volume of 100S. It is the number of shares in hundreds traded in the last trading day. Close, closing of price on the last trading day. Net change. It is a net change between the last two trading days. Let's have the buying or selling of stocks. To buy or sell stocks, one may go to PSE personally. However, most transactions nowadays are done by making a phone call to a registered broker or by logging on to a reputable online trading platform. Those with accounts in online trading platforms may often encounter a table such as the following. In the table, the terms mean the following: bid size, the number of individual buy orders and the total number of shares they wish to buy. Bid price, the price these buyers are willing to pay for the stock. Ask price, the price the sellers of the stock are willing to sell the stock. Ask price, how many individual sell orders have been placed in the online platform and the total number of shares these sellers wish to sell. Bond Market Index. It is a measure of a portion of the bond market. Philippine Dealing Exchange and Corporation or the PDEX, the main platform for bonds or fixed income securities in the Philippines. Unlike stock indices, which are associated with virtually every stock market in the world, bond market indices are far less common. In fact, other than certain regional bond indices which have sub-indices covering the Philippines, our bond market does not typically compute a bond market index. Instead, the market rates produced from the bond market are interest rates, which may be used as a benchmark for other financial institutions. Government bonds. are auctioned out to banks and other brokers and dealers every Monday by the Bureau of Treasury, depending on their terms or tenors. These bonds are also called Treasury bills or the T-bills, Treasury notes or the T-notes, or the Treasury bonds or the T-bonds. The resulting coupon rates and the total amount sold for these bonds are usually reported by news agencies on the day right after the auction. Since these bond transactions involve large amount, these bonds are usually limited to banks, insurance firms, and other financial institutions. The banks may then resell these bonds to its client. Although the coupon rate for bonds is fixed, bond prices fluctuate because these are traded among investors in what is called the secondary market. These prices are determined by supply and demand, the prevailing interest rates, as well as other market forces. As the prices of the bond may increase or decreases, some investors may choose to sell back to the banks the bonds they acquired before their maturity date to cash in their gains even before maturity. Despite the fact that the bond investing is considered safer than the stock investing, there is still some risk involved. The most extreme scenario is default by the issuer. In this case, the investor can lose not only the coupons but even the money invested in the bond. Bond investors should thus not be aware of the financial condition of the issuer of the bond and the prevailing market conditions. For example, consider the following listing of stocks and answer the following. We have two stocks. We have the GGG and the HHH. We have the high for the GGG, that is 120, and its low is 105. Its dividend is 3.5. Its yield percent is 2.8. Its volume or the number of volume is 4,050, and close, that is 118.50, and the net change is negative 0.50. For the stock HHH, we have the high, that is 16, for low, that is 12. The dividend is 0.9, the yield percent is 1.1, the volume is 1,070, its close is 15.80, and net change, that is 0.10. The questions are: what was the lowest price of stock for the last 52 weeks? What was the dividend per share last year? What was the annual percentage yield last year? What was the closing price in the last trading day? And what was the closing price the day before the last trading day for the stocks GGG and HHH? For our analysis, we have our solution for the stock GGG. The lowest price for the stock GGG is 105 pesos. Its dividend per share is 3.5 pesos or 3.50 pesos. Its yield percent is 2.8%. Its closing price is 118.50 pesos. And its closing price as the day before the last trading day is 118 pesos 0.50 plus 50 cents is equal to 119 pesos. For the stock HHH, the lowest price is 12 pesos. Its dividend per share is 90 cents. Its yield percent is 1.1%. Its closing price is 15.80 pesos. And its closing price is from the day before the last trading day is 15 pesos, 15.80 pesos minus 10 cents is equal to 15 pesos and 70 cents. Let's have the definition of terms of theory of efficient markets. First is the fundamental analysis. Analysis of various public information, example, sales profits about the stock. Technical analysis. Analysis patterns in historical prices of stocks. Weak form of efficient market theory. It asserts the stock prices already incorporate all past market trading data and information. It's historical price information only. Semi-strong form of efficient market theory. It asserts the stock prices already incorporated all publicity available information only. Semi-strong form of efficient market theory asserts the stock prices already incorporate information only, public and private. The theory of efficient market. The stock prices already reflect all the available information about the stock. This means that the stock prices are accurate. They already give a correct measure of the value of a stock precisely because the prices are already based on all information and expectation about the stock. It is developed by Eugene Fama in 1970s. The slogan, "Trust market prices," can sum up the theory. One can trust market prices because they give an accurate measure of all possible information about the stock. Since all stocks are correctly priced because they are based on all available information, then there is no such thing as discovering undervalued or overvalued stocks from which to gain profits. Thus, the theory implies the investor cannot beat the market even if they do a lot of research. In the end, investors will just find out that the correct price is what is already published. There are three forms of efficient market as discussed by Clark, John Dick, and Mandelker. First, weak form of the theory. Stock prices already reflect all past market trading data and historical information only. Thus, knowing past data will not give investors an edge. If the weak form of the theory is true, then a technical analysis, an analysis of the past prices, will not yield new information and hence will not lead to systematic profits. Second, semi-strong form of the theory. Stock prices already reflect all publicity available data, including those involving the product, management team, and financial statement competitors and industry. If the semi-strong form of the theory is true, then doing a fundamental analysis, gathering all public data, will still not lead to systematic profits. Last, strong form of the theory. All information, public and private, are incorporated in the price. If the strong form of the theory is true, then the investors still cannot gain systematic profits even if they gather information that is not yet publicly known. If you have a question, queries, and clarification, feel free to PM me in my messenger account that is Kim Francis Season Alam. Till next video lesson, goodbye!